Hey guys, it's Sean Kelly with Kelly Realty. Today we're going to be analyzing a investment property that's currently listed in Bennington. It's 9 units and then they're asking $525,000. We're going to be using the 4 square method today because I feel like it's very easy to follow and easy to understand. In the first square, we're going to start with income. There's multiple types of income, but the most obvious one is rental income. So rental from the 9 units. I got these numbers from the seller on their rent roll, which displays all of the rents that they're getting per unit. I've gone ahead and added them up already. For the 9 units, it's bringing in $6,600 per rent. There's other rent type or other income types that you could get, like coin laundry or pet laundry or pet leases and miscellaneous rents. But there is no coin laundry for this property. The pet income is $150 a month, and there are no miscellaneous other incomes. We're going to add this up for the total monthly income. And we get $67.50. So we're going to put that in a little box here for total monthly income. Now the second square that we're going to use to analyze is expenses. And obviously this is a lot bigger because there are more expenses than there are income typically. And this is where investors typically make their mistake because they don't analyze all of the expenses. So there's a couple expenses that we start off with here for taxes, property taxes, and insurance. A lot of times these are wrapped up into your loan, but for today's purposes, we're going to break them all up. The taxes for this property were about $9,900 a year. Divided by 12 will get you $825. Insurance was about $4,200 a year for all 9 units, which is about $350 a month. Other expenses to consider are utilities. These could be gas, water, electric, and sewer. So those are something to consider. For this property though, these expenses are paid for by the tenants, so there's 0 utility expenses. Another expense to consider is if it is a condo or townhome, an HOA fee. For this property, there was none. Another expense to consider is vacancy. So this is time while the units are not rented. So if someone moves out, there's a little bit of vacancy. In our market, we usually take vacancy as 5% of this number. And 5% of $6,750 is $337 a month. Another expense that you should consider is lawn and snow removal. I got this number from the seller directly. He said he spends about $90 a month. Another expense is the mortgage. So this would just be principal and interest. Again, the purchase price is $525. You can go to any Google search and type in a mortgage calculator to get this number, but putting down 20%, and so the mortgage would be for $420,000. at 4% interest rate, which is typical for today's market. Over a 30-year period, that number would come out to be $2,005 a month. Couple other expenses that you should consider are repairs and maintenance. A good rule of thumb would be $50 per unit per month. So $50 times 9 would come to $450. And this would take care of stuff like leaky faucets, any sort of small repair that you might come across. Another expense is capital expenditures. Another good rule of thumb would be $50 per month per unit, and this would take care of stuff like roofs or furnaces or air conditioners. And lastly, the last expense that you should consider is property management. So if you pay for a property manager to manage your property for you, in our market, it's typically about 10% of the monthly income, so $675. Now we're gonna add all of these up to get our total monthly expense. So when I added these up, I got the number of $5,182. We'll put this in green. 5,182. So again, this is where a lot of people kind of make their mistakes because they don't consider the repairs or the capital expenditures. So it's good to take into consideration those expenses to get a total idea of your expenses. Now in the third quadrant, we have cash flow. And cash flow is just your monthly income minus your monthly expenses. So we have $6,750 in income minus $5,182 in expenses. We get the total cash flow of $1,568 cash flow. Now, the next question would be, is $1,568 a month in cash flow a good number? The only way to figure that out is to take your yearly cash flow and divide it by your capital, your total investment, your total capital investment. So in order to do that, we would do a calculation. It's called cash on cash, return on investment. So in order to get your cash on cash return on investment, you need to include all of your capital expenses. The first one would be your down payment. So 20% of 525 gives you a down payment of $105,000. Another capital expense would be your closing cost. In our market, it's about $5,000. It includes title fees, appraisals, fees for getting the loan from the lender, stuff like that. And you're also going to want to consider any repair costs or rehab costs that might need to go into this property when you buy it. I actually walked through this property and kind of did my own calculation based on what I think it would cost for repairs and maintenance. So rehab cost be about $30,000, I'm estimating. So your total investment is $140,000. Then to get your cash on cash return, you take your monthly cash flow times 12 to get the total cash flow from the property. For my calculation, I got $18,816. And you just take that number divided by 140. So 18,816 over 140 equals 13.44%. That is your cash on cash return. Now, in order to decide whether or not that's a good number, you just have to think about what kind of return you could get with that money if you put it somewhere else. For example, if you put it in the stock market over the last 100 years, the stock market has gotten about a 6 to 7% return year over year. So 13% is roughly double that. I'd say it's a pretty good cash on cash return, in my opinion. One thing that this four corner evaluation doesn't consider is your total return. We're just looking at the cash on cash return. So this is not including any appreciation that you might get on this number every year from it going up in value. And it's also not considering the repayment of the loan. So how much the loan is going down each year. So those numbers would take a little bit longer to calculate, but they would also be two benefits that this is not considering. So this is it for today's analysis of the investment property that's in Bennington, Nebraska. It's currently on the market. I think it's a good investment, and I'm going to be looking to do one of these once a week. So if you guys want to tune into more deal analyses, just follow our page. If you liked this little demonstration, be sure to like the video and share it with anyone that you think might benefit from it. Thank you very much.